Japan's yen just hit a 40-year low, 160 to the dollar. That number triggered a chain reaction across an entire region. And right now, the Bank of Japan faces an impossible choice: raise rates and risk financial collapse at home, or let the currency fall and trigger a global meltdown. I'm David, and this is what's about to unravel. The yen crossed a line in May 2026 it hadn't crossed since 1986. 160 to the dollar. The Bank of Japan had set this number as the intervention threshold years ago, the point where weakness became excessive and required the central bank to buy yen and sell foreign currency to defend it. When the yen hit 160, the BOJ did exactly what it had promised. They intervened. It lasted hours. By the next market close, the yen was sliding again. That failure matters. A central bank can't defend a currency it no longer believes in, and the BOJ, for the first time in decades, isn't sure the yen is worth defending at this level. The weakness isn't random currency trading noise. It's the sound of Japan's entire fiscal strategy collapsing. The government has spent 30 years borrowing, building a debt that now sits at 220% of GDP. Every yen of that debt was borrowed cheaply, back when Japan could borrow almost for free. Now investors are waking up to the math. If the yen falls, the debt becomes more expensive. If the bank raises rates to defend the yen, the debt becomes more expensive in a different way through higher borrowing costs. The central bank is caught between defending a currency and keeping the government from bankruptcy. And it turns out you can't do both. Watch that orange bar climb back up to pandemic levels. The supplementary budget for 2025 is now 1.3 trillion yen, the biggest injection since 2020. That's not a one-time fix or a small relief package. That's a reversal of years of austerity. Every yen came from new government borrowing. The debt just got bigger, and the yen got weaker. The supplementary budget wasn't an accident or a policy detour. It was a choice by Prime Minister Takeshi Sani, who came into office convinced that Japan needed to spend its way out of stagnation. But every yen spent made the problem worse. Here's the trap the Bank of Japan sits in now. To defend the yen, it needs to raise interest rates. Higher rates make borrowing more expensive, which should reduce inflation and attract foreign investors to Japanese bonds. It's the textbook move. But Japan's government debt is enormous, and it's mostly held in the domestic bond market. The moment the BOJ starts raising rates, the yield on those bonds rises. And when yields rise, the value of existing bonds falls, which means anyone holding Japanese government debt sees their holdings lose money. So investors start selling. The more the BOJ tries to tighten, the more bond holders panic and exit, which drives yields up even faster. The Bank of Japan would be forced to buy bonds just to keep the market from collapsing, which defeats the entire point of tightening. The research points to this paradox. The BOJ needs to raise rates to defend the yen, but raising rates could destabilize the $8 trillion bond market and force the BOJ into a buying spree that locks it back into ultra-loose monetary policy. It's a loop with no exit. The yen weakness is bad enough in isolation, but the weakness is also feeding a much larger crisis, the unwinding of a massive carry trade that's been building for 15 years. A carry trade is simple. Borrow money in a currency with near zero interest rates in this case. The yen then lend or invest that money in higher-yielding assets around the world. As long as the yen stays stable or weakens, you pocket the difference. Traders and hedge funds have done this at enormous scale. Estimates put the global carry trade positions at around $4 trillion, funded entirely in yen. Much of that leverage is extreme. Some positions run at ratios of 1 to 10, meaning a 10% move in the yen or a 10% drop in the underlying asset triggers a margin call and forces liquidation. What's starting to happen now is obvious. The yen is strengthening, the carry trade is unwinding. Positions that were profitable for years are suddenly underwater. Margin calls are firing. And when $4 trillion in leveraged positions start liquidating at the same time, they don't exit quietly. They crash. They sell whatever they can, wherever they can. The research identifies this as a cascade risk. One market breaks, which forces selling in another market, which triggers more margin calls elsewhere. The carry trade isn't a financial crisis yet, but it's the trigger. The carry trade risk would be bad enough on its own. But it's not happening in a vacuum, it's happening as Japan is already bleeding economic strength from a second shock: energy costs. When Iran and its coalition partners escalated military operations in October 2025, oil prices spiked. For a country that imports almost all of its oil, Japan felt that shock immediately. Energy costs surged, eroding household purchasing power and pushing inflation higher. The Bank of Japan has to fight inflation by raising rates or tightening policy. But raising rates makes the yen stronger, which should help importers by making overseas oil cheaper. Except the yen has been falling, not rising. So Japan is stuck paying more for energy in a weaker currency. It's a double hit. The research baseline projects that oil will ease by mid-2026 and drift toward normal by late 2028. But that relief is fragile. If the Iran conflict escalates into a wider regional war, or if a naval blockade chokes the Strait of Hormuz, oil could spike to $150 a barrel. The BOJ has no good options if that happens. It can't raise rates without risking the bond market. It can't ease policy without letting the yen fall further. And the energy shock keeps inflation from fading. The window for a clean, gradual fix is closing. Japan's crisis would be manageable if it stayed in Japan. But when the yen carry trade unwinds, it exports the pain across an entire region, and one country is in the crosshairs: Indonesia. Indonesia isn't a household name in most Western newsrooms, but it sits at the center of Southeast Asian finance. It's the largest economy in the region, with the most developed stock and bond markets. For 15 years, carry trade investors have poured money into Indonesian assets to capture higher yields. Now those flows are reversing. Capital is leaving. The rupiah is weakening. And Indonesia's central bank is running out of ammunition. According to the data we reviewed, Indonesia's usable foreign exchange reserves sit at roughly 2/3 of its reported total, which means the central bank has already drawn down hard to defend the currency. The government's fiscal deficit is closing in on its 3% legal ceiling, which means there's almost no room to spend or cut interest rates if a crisis hits. And in May 2026, the government tightened capital controls. It halved the limit on domestic dollar purchases, signaling panic. Indonesia is one panic out of a full capital flight. If Indonesia breaks, the contagion spreads fast. The Philippines faces similar exposure. Thailand and Vietnam are already managing fiscal strain from energy subsidies. Pakistan's forex reserves have dipped below the IMF's recommended safety floor. A rupiah crash, combined with yen weakness, could force simultaneous currency devaluations across the region, triggering a cascade of defaults and emergency capital controls. But Japan's crisis isn't Japan's alone, and Washington has already made a bet that it will handle it cleanly. In May 2026, U.S. Treasury Secretary Scott Bessent flew to Tokyo to meet Prime Minister Takechi and Finance Minister Katayama. The meetings were meant to address trade tensions and coordinate on economic policy. But the real message came in the joint statement. The United States, which has historically punished countries for weak yen policies and currency intervention, was now saying it supported Japan's intervention efforts. That's a reversal decades old. Why? The U.S. Treasury understands what the research makes clear. A sudden, chaotic yen collapse would send shockwaves through U.S. markets too. Japanese investors hold massive amounts of U.S. treasuries. A yen crisis would force them to sell dollars to cover losses at home, which could spike U.S. interest rates and crash U.S. stock values. The U.S. also needs Japan stable for geopolitical reasons, supply chain resilience against China, semiconductor manufacturing, military coordination in the Pacific. A destabilized Japan is not useful to Washington. So the U.S. has made a quiet choice. Let Japan intervene at will, support its efforts publicly, and coordinate through back channels if the carry trade unwind accelerates. This isn't altruism, it's self-interest, but it does buy Japan some time. Time, though, is the thing Japan might not have. The carry trade positions are unwinding. The yen is already under pressure. The Bank of Japan must choose, very soon, which crisis it will accept. The research identifies three possible paths. First, managed depreciation. Japan accepts yen weakness for the next year or two, tolerates higher import costs, and uses the time to rebuild fiscal credibility, cutting deficits, raising taxes, convincing investors the government won't default. It's painful, but it avoids sudden collapse and gives the BOJ room to gradually raise rates. Second, coordinated G7 intervention. Japan, the US, Europe, and others mount a massive buying campaign in yen and foreign exchange markets like they did in 1998 and 2022. Hundreds of billions from foreign exchange reserves deployed to anchor the yen, buying time for internal stabilization. It works if the commitment is credible. It fails if markets don't believe it will last. Third, capitulation. The BOJ raises rates aggressively, accepting that bond yields will spike. The Japanese government bond market will convulse. Contagion will ripple across Asia. It's a shock, but a known shock. At least investors know where they stand. One of these three is coming. The mechanism is already in motion. The question is which pain Japan chooses and how badly it spreads. The yen's collapse isn't a currency story. It's the reckoning with 30 years of borrowing catching up all at once. Subscribe and I'll walk you through what breaks next. I'm David. See you tomorrow.